You're watching BTV.
Any company developing a gold project has two key goals: get the project into production and establish positive cash flow as quickly as possible. The same applies to Contango ore. Fortified by a joint venture with Kinross, Contango has developed a business model that has enabled it to reach production at its Manh Choh project in Alaska in a remarkably short time frame. This unique approach has enabled Contango to quickly get a foothold in a very demanding space.
Rather than develop our own mill and tailings facility and all that, we are simply using the one that Kinross has operated at the Fort Knox mine for 30 years. In today's world, if you were permitting a tailings facility with hundreds of acres of impacts to wetlands and waterways, that would take you at least 5 years, maybe longer. By not building a tailings facility in the mill, we minimized our environmental impacts, which allowed us to be able to permit the project start to finish in about a year and a half. So we saved in capital, we saved on time, and we don't have that typical brand new mill startup. Fort Knox mill has been operating for 30 years, so they understand and know the mill really well.
Another unique characteristic of what Contango calls its hybrid royalty model is the fact it only has 12 employees.
When you look at the amount of cash flow per individual employee, it's a very high ratio. We're cash flowing $6 per share per employee. The revenues we're generating is over $12,000 per employee. And that is identical to what the royalty companies do. That's why they have such good, strong valuations.
In addition to these impressive valuations, Contango recently reached an important milestone.
So at Manh Choh, we achieved our first gold production in Q3. We're going to generate about 67,500 ounces of gold for our credit. That's going to generate a lot of free cash flow. Our all-in sustaining costs are $1,116 an ounce. We got gold at $2,500, so you can do the math. We're going to generate a lot of cash flow. The mine itself will produce over 200,000 ounces of gold. It's not a small mine. It's 8 grams per ton. It's one of the highest grade open pit gold mines in the world. So it's a very robust project.
Given Contango's recent successes, gold analyst Richard Gray believes the company's direct shipping ore approach can continue to provide an important competitive advantage.
Contango's upside is extremely high because they can use this model multiple times over and add to their production profile very quickly without having to access capital markets or use a lot of debt, or really to dilute the share count much more than it already is.
Contango already has a pipeline of projects that they believe will be a good fit with their business model.
We have 2 other projects that are right behind Manh Choh, our Lucky Shot project and our Johnson Tract project. And our 5-year plan is to develop those using that direct shipping ore model, not building a tailings facility and a mill and a power plant. Because they're high grade, we can direct ship it to an existing facility.
With production of its first gold bars and the promise of its Lucky Shot and Johnson Tract projects, Contango is feeling a rush of momentum.
It's a fantastic time to be in the gold space. We have $2,500 gold and we're generating cash flow, and we've got some exciting exploration projects that we know we can advance with our existing cash flow. I think we're in really good shape for our investors to continue to add value.
Contango's 5-year plan is to get the Lucky Shot and Johnson Tract projects online and increase gold production to about 200,000 ounces a year.